Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is January 20 and it is a weekly markets update. Let's have a look at the news of week 3 and see what are the next trends. Bullish trend continued rolling out in the urea market last week. Egyptian producers increased their sales price step by step, reaching as high as $432 FOB. Firming trend is supported by robust demand from Europe, Turkey, and also US, where it just starts to evolve. European markets woke up and started purchasing. Prices there were estimated around $440 to $50 CFR duty paid. There is expectation that a significant amount of product is still needed to be imported in front of the season, somewhere around 400,000 tons, more or less, and clock is ticking quickly in terms of shipping window. Turkey is hungry for product because Iranian supply is out of question, and the expected amount of imports is evaluated between 150 and 200,000 tons. However, looks like current price level is close to the ceiling, and buyers become very cautious and willing to risk to purchase significant amounts at such high price. Another factor for European buyers is strengthening dollar against euro. Despite positive dynamics in the European market, German producer SKW Pisteritz has yielded to its ammonia lines and respectively urea and UAN production. In the press release, producer indicated that massive cheap imports from Russia and increasing gas price don't leave any other option to them, unfortunately. Black Sea prices increased respectively to the level of $395 to as high as $405 FOB. Ukraine is the main direction of exports for now, because active purchasing season continued after the holidays. Imports in December 2024 reached almost 54,000 tons, much higher than past year figures. And appetite for imports in Q1 seems to be very strong. At least 150,000 tons of imported product is expected to be needed in the Ukrainian market. Other African producers also increased price tags. Algeria target was around $440 FOB, with availability limited until at least second half of February. Nigeria closed a sales tender for 3 lots of 300,000 tons each for beginning February, but price will be clear later this week. Ethiopia bought another lot as a part of its January 8 purchase tender at high 380s level from Middle East. Spot indications from Middle East climbed to $385 to $95 FOB, but in front of the Indian tender there is not so many proposals in the market. Kaltin closed a sales tender last week, succeeding to receive a proposal at $411, which is $20 higher versus price in January 10 tender. The demand from Australia and Southeast Asia starts to emerge, so regional availability also looks tight. In the US, barge prices surged to the level of $368 per short ton for February. Market expects that about 2.5 million tons US needs to import before April, and thus slowly with these increasing prices, US destination becomes more attractive for exporters versus Latin America. Demand in Brazil and Argentina is subdued for now, so cargoes will need to more and more divert to the US. Paper values surged again. Egypt FOB increased to the average $417 for January, $420 for February, and to $408 for March. NOLA values climbed to the average of $357 per short ton for January, $368 for February, and $375 for March. Arab Gulf FOB reached average of $379 for January, $385 for February, and $380 for March. Brazil CFR for January corrected to $379 and for February and March to $385. Ammonium sulfate prices also firmed up. in part due to tightness in urea and also as demand in certain markets increased. Demand from India was imminent. The inquiry for 20 to 30,000 tons of standard product is circulating. In Southeast Asia, there are several ongoing tenders. One from the Philippines for 8,000 tons and one in South Korea for 3,000 tons, both standard as well. In Mexico, after the 35% import duties were lifted, Tepeyac has booked one vessel already and several large inquiries for both standard and granular product circulate. In coffee closed 2 tenders that were announced last week. Looks like both standard and compacted product will be sourced from China. Chinese FOB prices for copra grade increased to $137 to $42 and for granular to around $152 to $55. However, of course, price dynamics is far from urea base. In Europe, demand for copra OAS has increased. After increasing the urea prices, producers were selling in the range of 175 to 85 euros FOB in Northwest Europe and targeting 5 to 10 euros more. In the US, prices increased again. Advances issued new prices last week that are $25 to $30 per short ton more for all terminals. In general, the market is very tight, and only additional imports may help to ease it. After the round of significant price increases for nitrates in Europe a week ago, market stabilized more or less, but still continues to be firm. The demand in Q1 looks very promising, which is a combination of several factors, specifically high gas price, slower sales pace in Q4 across European markets, and of course, rally in urea prices. In Germany, Yara has withdrawn its previous prices for CIN because it is sold out for February and will return with March prices soon. LAT nitrogen increased price for CIN in Germany to €335 last week. In the UK, CF Industries once again increased price for ammonium nitrate to £350 delivered for February and £5 more for March. UN demand is quiet, and prices were mostly stable both in Europe and in the US. US supply-demand balance looks rather tight because several export sales conducted last week, but it hasn't affected prices. In ammonia market, prices were softening again. In Europe, there were no new business registered, and prices decreased by $10 more to the level of $585 to $95 CFR. Despite high gas prices negatively affect European ammonia producers' profitability, demand for import product hasn't jumped yet. There is certain interest from multiple European buyers floating in the market, but on a decreasing trend, buyers prefer to take wait-and-see position. Middle East prices dropped to $360 to $80 FOB, which is about $20 versus previous week. So all producers in the region are very long now. The only help might arrive from sales west of Suez, which start to make sense now, while interest from India is very limited, and target CFR price level is even lower than that current Middle East fall. India feels comfortable for January and February, while some fresh demand might emerge for March. In the US, both import and export prices corrected downwards following the international trend. Physical dynamics is still seasonally subdued, but recent improvement in crop prices might push ammonia purchases in front of the season. Shipments from Trinidad resumed at usual level after previous production disruptions. Phosphates market saw several big developments last week. First of all, India CIL agreed phosphoric acid contract prices for Q1 2025 deliveries with Jordan's JPMC at $1,055 CFR, including 30 days credit. This marks a modest $5 per ton decrease from Q4 price. The decrease is small and probably not material enough to change the DAP stock situation in India. But in any case, contract settlement is a sign for stability. Some market sources say they expect negotiations between India and OCP to restart at this stage on this new basis. For now, Indian DAP stocks are evaluated at the level around 1.4 million. And of course, more will be produced domestically during Q1. For April, estimates point to DAP stocks being around 2 million tons, and if the deal with OCP is concluded, they may reach 2.5 million, quite a healthy level. In terms of spot business, no new DAP sales happened in India. In Ethiopia, EABC has awarded 3 cargoes total 150 to 80,000 tons in its December 23 tender from Saudi Arabia and Jordan at the level of $636 to $39. However, it is only 1/4 of the volume that EABC originally tendered for, so perhaps we will see another tender sometime soon. European demand was more vivid in certain countries last week, particularly for DAP. Italy, UK are seeing an uptick, although not large volumes are moving yet. Egyptian NCIC reported sales of 15,000 tons of DAP in its latest January 8 tender. Most likely this volume will go to Europe, shipment in January. Also, OCP reported about sales to Europe of 26,000 tons of DAP in total. Price level remains mostly the same as before, between $610 to $25 FOB for January-February loading. In Brazil, there was a sale of 20,000 tons of MAP of Russian origin that happened at the same $630 to $35 CFR level for January loading. Other than that, there is not much happening in the South American markets now. After an active start of the trading week, with a DAP barge trading at $588 per short ton FOB for second half February, and 2 MAP barges at $580 to $85 for January-February, there was no more significant business done at NOLA in the US. In China, there is still no sign of exports. Domestically, the industry is looking for more price declines to improve DAP offtake. China Phosphate and Compound Fertilizer Industry Association meeting was supposed to take place last week to see what they can do. Perhaps this week we might hear some news, if any, of course. There were also a couple of company-related news that caught my attention last week. First of all, information appeared that Polish Grupa Azoty is considering sale of Compo Expert, producer of specialty fertilizers. Poor financial situation of the company pushes it to look for various options. However, the decision is not taken yet. Second, US phosphate producer Mosaic told that they will sell its phosphate asset in Brazil. The buyer will be the company called Phosphates, which belongs to the owner of Galvani Fertilizantes, large domestic producers. The deal is for $125 million. Moving to the fundamentals. European natural gas futures firmed to slightly above 47 euros per megawatt hour, reflecting steady supply, even as colder weather drives up demand. Gas storage is lower than it was last year, 65% versus 77% in 24, but there is no immediate risk of shortages. Forecasts show colder than normal temperatures in northwest Europe from this weekend, along with weak wind power generation until January 24, which will increase the need for natural gas. At the same time, the EU is considering banning imports of Russian LNG as part of potential new sanctions. While pipeline gas imports from Russia have decreased over the years, Europe imported record amounts of Russian LNG in 2024. US natural gas futures cooled down on Friday to below $4 per MMBTU, retreating from a 2-year high reached on Wednesday, as forecasts pointed to milder weather in February. The American weather model shifted significantly warmer overnight, reducing heating degree days by 13. Prices rose in the previous 3 sessions amid predictions of colder weather, which was expected to freeze gas wells and pipes, driving up heating demand. Meanwhile, data showed a significant withdrawal of almost 260 billion cubic feet of gas from storage for the weekend in January 10, far exceeding the 5-year average. Analysts anticipate even larger withdrawals, exceeding 200 billion cubic feet for the past and this week, due to increased heating needs. Additionally, gas flows to the 8 major US LNG export facilities have hit a record daily high, further boosting overall demand. Agricultural commodities futures prices continued increasing. Wheat futures climbed to $5.39 per bushel. This move is mostly related not to wheat market dynamics itself, but rather to very positive dynamics in corn and soybean. Wheat futures supported this growth. US export this marketing year by 9% outpaced the level of past year, standing now at 17.5 million tons. At the same time, French authorities has put French wheat exports for the season at 3.5 million tons only, which is 66% decrease versus last year and the worst result in almost 30 years. Corn futures jumped more to the level of $4.85 per bushel, reaching their highest level since December 2023. Since USDA tightened ending stocks for this year, corn future price continues increasing, despite of uncertainty with weather in South America, particularly Argentina, and also new administration governments. The very important factor now is that funds are investing heavily into March future contracts, and they have significantly expanded their long positions. Moreover, as market analysts say, funds might push further to a record long. So all these factors result in such significant price upward trend. Soybean futures rose to $10.34 per bushel on Friday, driven by concerns over Argentina's weather and cautious optimism about US-China trade relations. The market received a boost after US President-elect Trump discussed trade with Chinese President Xi Jinping, signaling potential easing of tensions between the two countries. However, lingering concerns remain as China, the world's largest soybean buyer, has increasingly turned to cheaper Brazilian soybeans amid fears of US import tariffs. Additionally, uncertainty about crop conditions in Argentina has supported prices. While recent rains were expected to offer temporary relief for Argentinian crops, hot temperatures have caused significant deterioration in crop ratings, and the rains are unlikely to provide long-term recovery. These factors combined to lift soybean futures ahead of a long holiday weekend, reflecting both geopolitical developments and global supply risks. Moving to the shipping industry. Containerized freight index dropped by 7% further. Due to increased capacity, spot rates for all main routes from China to the US and vice versa decreased by 1 to 4%, depending on the route. Seems like front-loading eased a bit in front of the new administration potential tariffs increase. So, market analysts expect further shipping cost decrease in upcoming weeks. The Baltic Exchange Dry Bulk Index dipped again by almost 6% and reached the lowest level since July 2023. The main problem arose in Capesize segment, which started the week positively but then lost momentum by Friday. In the Panamax segment, despite some gains on specific trades, these improvements remain barely above operating costs, and the immediate outlook appears bleak, offering little reason for optimism. Situation in Ultra Supermax segment was also gloomy as limited fresh inquiry appeared and prompt tonnage remained readily available across the basins, same as in Handysize. However, market players believe that we will see reverse of this negative trend soon, as the market is on the edge of profitability in all regions, which cannot last long. To sum up, price rally in urea continues and helps price firming in other nitrogen segments as well. Europe woke up and started purchasing slowly, as well Turkey to a lesser extent, while other big buyers will step in later in Q1. Indian urea purchase tender that will close this week will show direction to the market, but there is no sign of softening, at least until second half of February, taking into account tight supply in the Middle East and firmer than usual global demand. Nitrates prices also increased, but at a slower pace, now after a round of significant increase a week ago. Phosphates price level remains mostly unchanged, with India and Ethiopia leading the purchase activity globally. At the same time, ammonia price continued softening quite quickly due to lack of demand and abundant supply. European gas prices are quite volatile, floating at comparably high level. Gas price in the US climbed more this week amid expectation of colder weather and record LNG exports. Agricultural commodities future prices were all in green, especially corn, where funds continue getting longer and longer. Dry bulk shipping activity remained subdued across all segments, and cost of container shipment also dropped last week. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.